Equity Market Update, February 2020. In February 2020, Indian markets fell by approximately 6.5% in line with global markets, driven by concerns over expected supply chain disruption and global growth due to rapid spread of coronavirus in China and other major countries like Japan, South Korea, United States, etc. For the month, mid and small caps also declined, largely in line with large caps. Most sectoral performance was weak, with auto, metals and capital goods underperforming significantly. Global equity markets were also under pressure in February 2020, and most major indices globally delivered negative returns. FPIs remain net buyers in the month and bought equity of $0.3 billion in February 2020. Total FPIs equity inflows in 11 months of FY20 have been $9.6 billion as against outflow of $4.8 billion during the corresponding period last year. Net inflows in domestic equity-oriented mutual funds were INR 7,696 crore in January 2020 compared to net inflow of INR 4,017 crore a month ago. For FYTD20 till January 2020, total flows in domestic equity-oriented mutual funds stood at INR 45,732 crore. Q3 FY20 results of corporate banks, cement and telecommunications were better than expectations, whereas retail banks, NBFCs and utilities were largely in line with the expectations. Results for auto, consumer staples, information technology, oil and gas, metals and pharma were below expectations. Outlook. As on 29 February 2020, Nifty 50 was trading at price to earnings multiple of 16.8x based on FY21 estimated earnings and 14.1x based on FY22 estimated earnings. These are reasonable multiples, especially in view of improving profit growth outlook. While discretionary consumption has slowed down, it directly impacts stocks whose weightage in Nifty 50 is less than 15%. Markets thus hold promise over the medium to long term, in our opinion. With the sharp decline in mid-caps and small caps since the beginning of 2018, significant divergence with large caps is not likely going forward. Further, Department of Investment and Public Asset Management Secretary recently mentioned that exchange-traded funds, ETFs, are going to be the less preferred route for divestments going forward. This should lead to better valuations of PSUs, as regular supply of shares through ETFs was a big overhang on their share prices. Further, it is worth noting that the gap between 10-year G-Sec and 1-year forward Nifty 50 earning yield has reduced significantly, and it is now below 10-year average. This indicates that equity markets are attractively priced. In view of the above and expected recovery in earnings, there is merit in increasing allocation to equities in a phased manner, or in staying invested as the case may be for those with a medium to long-term view and in line with individual risk appetite. Significant delay in containment of coronavirus, adverse global events, rise in crude oil prices, sharp moderation in equity-oriented mutual fund flows, delays in NPA resolution under NCLT are key risks in the near term. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.